Have you ever killed off a metric at Faire?
We have a weekly business review. There were 800 metrics in this review, like the slides, and there's a scorecard. That's a massive signal to noise challenge.
How do you think about ownership of metrics?
Every important business metric should have a business owner and then should have a financial or analytical owner.
It sounds like you're making a portfolio of risk-adjusted bets.
Even looking at it from the core, emerging, and then this experimental stuff, these are long-term bets. Not all of them will work out. The experiment is definitely an element of risk.
If you could tell your younger self something knowing what you know today, what would you tell him?
There was this finance blog called Mergers and Inquisitions. It was like, you start as an analyst in investment banking, then you go to business school, and then there's this kind of linear progression to this concept of greatness. And the reality is, like, life doesn't work that way.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to Run the Numbers, the show where I just ran up the stairs and I am really out of breath. The show where we talk with the world's top CFOs and finance leaders about how great companies are actually built. Whew. I'm CJ, a tech CFO, and my goal is to unpack the frameworks and operating principles that make you better at your job. On today's show, I'm speaking with Jason Lee. Jason is the CFO of Faire, one of the leading wholesale marketplaces connecting independent brands with local retailers. It's a company that sits at the intersection of marketplace dynamics and vertical software. This is like the secret sauce, baby. Before joining Faire, Jason spent more than a decade at Square, where he helped scale the business through hypergrowth. He led the IPO process and he ran investor relations. In this episode, we go deep on how Faire works, who it serves, how it makes money, and the metrics to track in a marketplace business, ROI as a decision-making framework, what actually goes into it, how teams over-rotate on certain components, and why discipline isn't about saying no, but knowing where to say yes. Lessons from scaling Square, figuring out the right way to measure a complex payments business, and what Jason learned working alongside Sarah Fryer, name drop CFO of OpenAI. High-stakes finance moments, leading Square through its IPO, navigating pricing below the last private round, and what that does to your mindset as a finance leader and employee. And finally, resetting valuations proactively in the private markets and how to run tender offers. If you like this show, please remember to like and subscribe. It'll help us with our algorithmic overlords. And hey, if you're looking to hire some finance and accounting talent, I would really love to help you. I run a recruiting service that pairs you with thoughtful, qualified candidates from our warm community of finance leaders, people who voluntarily debate LTV to CAC frameworks and tender mechanics on weekends. If that's of interest, shoot me an email at talent@mostlymetrics.com and we can talk. On to today's episode with Jason. Jason, thank you so much for joining me on the podcast today.
Oh, thanks for having me. This will be fun.
To start off here, Faire is a superstar in marketplace and vertical software circles, but not everyone may be as familiar with the company. I'm hoping you can just give us the overview of who Faire serves and maybe how it makes money.
We're a technology platform for retail wholesale. Now, like, what does that mean in like practical terms? We help independent retailers source and curate what to buy, then manage all of the workflows on kind of buying. And so for a little bit of background, inventory or product is the retailer's single biggest investment. It's like 50 to 70% of their spend or their budget. And like when you actually think about it, buying the right products is arguably the single most important mission critical job, right? If a retailer buys the right products, it actually sells through to their customers, they grow, they get revenue. And even though it's the most important job, the wholesale buying experience is super fragmented. It's very offline, right? Think of it as like it happens in trade shows. It happens with sales reps, with paper catalogs. There's emails, there's text messages. And so there's just a lot of guesswork and very little data. There's like three kind of main premises is that we help retailers with one, smarter discovery. We have a network of brands, a network of products and brands. And then we use AI, machine learning, have our kind of online platform to help retailers find the relevant product, curated set of products for their store and for their taste, right? They're not buying pencils. They're buying something that's like meaningful and special to kind of, and more curated. The second part of that is like the workflows, right? So like you and I, we go on Amazon, we go to like any kind of e-commerce website, you buy something, you click, you check out, you're done. Wholesale ordering, you actually have to think about the ordering, the payments, the invoicing, the shipping, when is it coming? And just there's so many more aspects about it. So we help bring all of that workflow into one place and make that as seamless as possible. So that two is workflows. And then the third part is buying power, right? The individual retailer lacks buying power. So we can use our data, our scale to enable either more benefits that they couldn't already get, right? So we give them things like net terms, we give them things like free returns, right? Which big box retailers get, but the independents might not. And then because we can aggregate the buying power, how do we lower shipping costs? How do we lower product costs? And so we do all of that stuff to help solve this problem. And you have to take, you have to solve all three of those problems to really, I think, bring this to life. Today, businesses run rating about over, $550 million of revenue. What's interesting is that the majority of that revenue is transaction based for us. So we earn a fee for every dollar that flows through our platform, right? We help retailers buy stuff and we take kind of fee on that part. But that revenue is highly recurring, right? So like why? Retailers come back to our platform and again because A, they find great things, they need to restock those great things they find. And you see it in our retention metrics. We have over 110% net dollar retention and actually over 95% gross dollar retention, right? So like you put those two things together, it's actually this like interesting concept where you have the stickiness and the mission critical aspect of a software platform, but then you have this spend expansion power and network effects of a marketplace, right? And all to serve this huge problem. But in a way, we kind of bring together these elements. It makes for certainly a fun time from a finance perspective.
What a beautiful business model. You're a juggernaut when it comes to marketplaces. And like if you don't play in the retail space, you may have not have heard of you before, but I'm having this vision of somebody walking a trade room floor, going to this conference out in like, I don't know, Cincinnati and trying to figure out, is this vendor legit or not? Should I order from them? Or the process of getting something in the mail and taking that big leap of faith. So there's also like the validation portion. There's the ability to feel secure in like what you're buying. It serves a huge need. And you can't have a store if you don't have stuff to sell, good stuff to sell.
You have to find good stuff to sell. And like to differentiate yourself, you have to curate the things for your like local customers and create in a way an experience for it. And it's wild that even today of how digital, how modern, like consumer e-commerce is just like, it's a thing where it's all so normalized. Like online penetration of wholesale buying is still operating 20 years ago, right? So imagine 20 years ago, e-commerce penetration for consumer e-commerce is, I think when you see a lot of the stats, like it's, 20%, 25%, 30%, it's like very clearly taking over. E-commerce and wholesale is still single digits. There's so much benefit, so much value that we can do by bringing on more digital, more modern, more data to that whole experience.
You mentioned the cadence of transactions. So listeners will probably make fun of me because I say this all the time. There's a difference between recurring and reoccurring. So recurring is the same amount at the same time, like on every single time. So like my Netflix subscription is recurring. Then the reoccurring is I use Uber very frequently. It's for different amounts because I go different distances, and it may be on a Tuesday versus a Thursday. And it sounds like from a surface level that you wouldn't be able to predict that, but when you zoom in on behavior and the job to be done, you actually do have a lot of predictability in that model.
It's a kind of byproduct of one, we're B2B, there's like B2B versus B2C, right? And so in the B2B world, because we're addressing something that is mission critical and is the disproportionately biggest spend pool, like it's buying inventory is way more spend than payroll, than marketing, than their staff, right? So it's the biggest surface area. It's the most important job. And so it is very much top of mind for our retailers. And so that's like kind of point one is like it's B2B, we address the most important part. And then I think fundamentally it's like you add enough value, right? That they just come back to you. It's super interesting to see the behaviors because there's certainly the like logical business rational aspect of it. The retailers want to go find great new things. And so they come back to it. There's joy in finding and sourcing products like the owners. This is like an actual owner decision. And some of them actually would describe it as is like, yeah, it's like I'm like going to Instagram and I'm just like thinking and imagining the vision of my store. One of the interesting stats is that like the average retailer, particularly for some of our like more tenured cohorts, they visit the platform at least or more than one time a day, right? So just like think about it, like they're coming back either to find stuff, right? To browse, to get ideation, or to like, figure out the ordering when things are coming in.
I spoke to Dave Yon, founder and managing partner at Tidemark, and they focus on a lot of vertical software. And he described to me that there are three different types of gravity. There's data gravity, like your ERP, or even with Faire, I'm sure you have order information that's critical. Then you have your workflow gravity. So how do you do something day to day in order to stay in business? And then there's the account gravity, which is the mind share of the owner of whatever business. And if you have that person, like hearing what you said about person coming back to it every day, that makes it super sticky to have the decision maker in there every single day.
We've like definitely taken a very distinctly end-to-end approach on the value props, right? Like we could have built a decent business by just attacking discovery, like help you find cool stuff. But if you actually like, how do we actually solve the underlying root problems? And like, that's where the workflow comes. That's where the buying power comes. And it creates every incentive for people to like want to come back. It both engage and there's like so many ways that they're getting value. We have so much data on the individual retailer, what they buy. We're actually integrated with their point of sale so we can see the stuff that's actually selling through. And so that's like so much powerful. And then you get the network, the data of the network, right? Of like what is going where, what profiles, like what attributes lead to these type of purchases or these assortments do well in this region. It then becomes an interesting like optimization of the network as well.
Hey, thanks for listening. We'll be right back after a word from our sponsors.
You just launched your new AI product. The new pricing page looks great. I'm talking crisp. But behind it, last-minute glued code, messy spreadsheets, and running ad hoc queries to figure out what to bill. Customers get invoices they can't understand. Engineers are chasing billing bugs. Finance can't close the books. Well, with Metronome, you hand it all off to the real-time billing infrastructure that just works. Reliable, flexible, and built to grow with you. They turn raw usage events into accurate invoices, give customers bills they actually understand, and keep every team in sync in real time. Whether you're launching usage-based pricing, managing enterprise contracts, or rolling out new AI services, Metronome does the heavy lifting so you can focus on your product, not your billing. That's why some of the fastest growing companies in the world like OpenAI and Anthropic run their billing on Metronome. Visit metronome.com to learn more. That's metronome.com. Here's a growth tax nobody talks about. Every new monetization model you ship creates a nightmare for your finance team. Add usage-based pricing? Now you're tracking consumption against commitments. Launch product bundles? That's multiple performance obligations per contract. Offer mid-cycle upgrades? Woo! Good luck reallocating revenue manually. But that's exactly where RightRev shines. RightRev is the revenue recognition engine built for companies that can't afford to let accounting slow down growth. When your rev rec is automated, your product team can ship new pricing without asking finance for permission. And your sales team can close creative deals without worrying about downstream chaos. To get up on my CFO soapbox for a sec, I love talking about creative pricing models, hybrid pricing, credits, tiered usage. But I've seen too many companies where the sales team is celebrating a huge quarter while finance is still trying to figure out how to recognize half of it. In a world where your pricing model might change 3 times next year, that flexibility is everything. If you want to scale your monetization without breaking your books, visit RightRev.com. That's RightRev.com, where modern monetization meets bulletproof accounting. Being a CFO, you know how much I love tools that actually make the lives of accounting and finance folks easier. One of my favorite tools right now is Rillet, the AI-native ERP going head-to-head with NetSuite. Yes, someone is finally doing it. I met Rillet 2 years ago when they were still in stealth. Since then, they've absolutely taken the finance world by storm. Their mission is to make the zero-day close a reality, and they're actually doing it. Customers are literally closing their books at 1:35 p.m. on the first day of the month. They've got everything you need to scale your business. Complex revenue recognition, native integrations, custom reporting, multi-entity, close management, and much more. They're only a few years in and are already supporting NASDAQ publicly listed companies. Yes, seriously. If you want to scale your business on an ERP that wasn't built in the 90s, you need to check out Rillet. Book a demo at rillet.com/CJ. Oh, cool, that's me. That's RILLET.com/CJ. RILLET.com/CJ. Tell them I sent you there. So you mentioned the network, and marketplaces are notorious for having lots and lots of inputs as well as output metrics. I'm curious, Jason, how do you distinguish between those two types, input metrics and output metrics?
I think there's lots of way to kind of approach it. The way I kind of try to frame it to myself, and I do think has been an evolution for me, is that output metrics are like fundamentally they're outcomes and they're outcomes. And that can exist at either the business level, the customer level, or in some respects, like the feature and product level, right? Input metrics, in some respects, are measurements of behaviors, of levers that drive those outcomes. And ideally, again, where you can control. I think in practice is where it gets pretty tricky is that there can be multiple layers between the inputs and then the ultimate outcome, right? And so like revenue is the highest level business output. And then it's a result of, the next level of outputs, new customer acquisition, retention, monetization, and you can have a bunch of other drivers. Then you like pick one of those, new customer acquisition, that is an output metric itself of the next layer of customers acquired, the average size, the average quality. And that's not even getting to segmenting it by different dimensions, right? Channels, size of customers. And so then, like, I've always tried to kind of force myself to think about, it's like, okay, let's be really clear about what's the business and or customer objective that we're trying to like measure. What is the outcome? What are we trying to accomplish? How does it matter for the business, right? And then I think this is, I think, a good place where like finance plays a role around, well, how does that ladder up and down, right? And how do you create that connective tissue? And I think the second thing is like this output and inputs, it's like really forcing you to think about, do you have an understanding of the business equation, right? In that the business equation of the components of the inputs that gets to the output, at the end of the day, you're hoping to pressure test, does these sets of actions that we can then measure actually create the output? Is it actually driving, not just correlated, but like actually causing that?
Can you say more about the business equation? I read a lot of newsletters. One that I love is Dan Hockenmeyer's, who I believe you work with, and he talks about this concept of how every business has essentially a formula.
The business equation, it's like, trying to formulate a way and understanding of like, how do you break it down into the components of the inputs? And oftentimes it's like, it kind of comes back to, do you have the right components? Do you have the right formula? And does it actually cause the effect? Historically, so much of the formula was P times Q equals R, right? Price times quantity. That business equation is a reasonable business equation, but it actually isn't reasonable for all businesses. That's why for us, like, you could create a very simplistic business equation of like number of customers times revenue per customer equals your revenue. And that formula is flawed for some businesses, particularly for us, where like, oh, we have a very wide distribution of customers. The average customer isn't really the average customer because there's a whole power law dynamic. And so thinking deeply about the business equation, I think is really important to really map. Do you have an understanding of like what actions actually materially drive your business or the output metric? And so you have to think rigorously about it. You have to have the right feedback loop about it. And it's like not a static thing either. I think business equations need to evolve as the business evolves or the customer behavior evolves.
How do you think about ownership of metrics?
My core belief here is that metric ownership needs to be shared. It needs to be shared for it to be meaningful. There needs to be clearly defined roles, but every important business metric should have a business owner and then it should have also a financial or analytical owner. The finance of the analytical owner is make sure the metric is well defined, well understood, is actually useful, and there's the right feedback loop. But the business owner equation is like you need to have a business owner that can then think about well, what is the learning and the action to go take to like drive activity, the right set of activity. So, as part of that, like I think I've been very particular about wanting to have on the finance team of like having embedded finance partners throughout the org. I call it little, like mini CFOs to then be close enough to the business or the product or the function to bring that financial context, but also to be better informed about not only are the right metrics, but what is the right shared ownership there. But it only works too if like you can have too many metrics and then all of a sudden like there's no ownership and like you dilute yourself because there's just too many. So you just have to be really deliberate about that.
I think the word shared is fairly nuanced because you could also take the position that if everybody owns a metric, then nobody truly owns it. To give you an example, let's say registrations. Say you're an inbound company. If everybody owns registrations, then it's going to be hard to impact any change if you want to toggle something up or down within the org.
I think it was very particular that it's shared, but there is also very clear what I call DRI, directly responsible individuals, right? And it's shared in that it's kind of the main point of like there is a owner from an analytical, like an understanding from the technical aspect of it, the metric definition, and then there's an owner from a business perspective, but it doesn't dilute the role I think that each plays. If you like really kind of come down to it, I do agree with your point that well, if you have too many people involved, it just dilutes the ownership and no one really feels responsible. So like you have to try to keep it as single threaded. There are some metrics where there's multiple contributors. If you think about product and sales and marketing, and at some point, like you just have to acknowledge is like, yes, there's multiple variables that contribute to this, but there is a theory from a business perspective that at least gets to ground truth and understanding, at least can then push and figure out those dependencies and understands all of those relationships. This is also where I do think the finance and analytical partners kind of also can play a big role, but you need the business side to drive the actioning of it.
You mentioned making sure you don't have too many metrics, right? You can suffocate under the weight of tracking too many metrics. Have you ever killed off a metric at Faire?
Nothing is free. It's like so easy to just say like, oh, there's no cost to this. I think one of the easiest mistakes for both finance teams, candidly, finance teams and companies is just continually adding metrics, right? Like at Faire, we love data. We love data to inform, but there is a cost, right? There is a cost of adding. And I think that there is a cost of the desire to want to add more data, more dashboards, more everything, because you think it helps give you more information to make better decisions. But there is a point and a threshold where that more metrics, more data actually starts to create more noise relative to the insight. And so there's something I like ask myself and I have kind of coined for myself is the signal to noise ratio. I'll give you a kind of tangible example. When I joined Faire, so one of the practices and cadences that we have is we have a weekly business review. It's gone through a bunch of different evolutions, but a weekly business review, and one of the aspects of it is to review metrics. And I literally counted, this is a weekly meeting, to be clear, there were 800 metrics in this review, like the slides, and there's a scorecard, and it's both in terms of like time series and then the number of metrics. And I think that level of detail, it comes from a good place. But if you could think about it, that's a massive signal to noise challenge, right? Particularly when you like really take it down to the individual. And so we made a very intentional decision of like, we got to sharpen, right? We can ask this question on, is it serving us in this moment on the right cadence? Should this be distributed to actually the true owner, like as a metric owner, should be distributed and pushed out to those forums versus trying to see everything. The way you could actually test it, just like print the slide deck or print the dashboard and just see how many pages it produces. And you're like, oh my God, you actually throw it out and you build it from scratch, right? Because then like, if you start from that, then you incrementally go from here, which is like, okay, let's come back to like first principles of what is the business equation? What really matters to look for this group of people? And you kind of start to think about, hey, what are the tiering of business level metrics versus deeper down? Are they in the right forums? What should we actually be measuring on a weekly versus the quarterly versus monthly? What's a check metric or monitoring metric versus a true performance metric?
Man, you put me to shame. I was going to give an example that one time I went from having 3 retention metrics to 17 in my spreadsheet, but wow, that's a lot to track.
There is the capacity of the team. For some businesses, I think customer count metrics, I think you have to be really careful about, right? Things like active customers. I think for some businesses, it makes sense. For other businesses, I actually don't think it makes sense, right? And so for us, we monitor our kind of customer counts. They're helpful to understand reach and breadth, but we never really actually had that as a core performance metric for us because of our wide funnel, because of the power law dynamics. When you actually think about it, like how a lot of companies define active customer metrics, it's like one payment or one transaction or one thing over a 12-month period or 1-year period. And it's like pretty low bar for what is actually a customer. And I remember at Square, actually, this is probably more at Square, like we looked at the difference between like one order for the last year versus 10 orders in the last year, right? And there was a big change in customer count, but a very nominal difference in revenue and volume. It kind of reinforces like, gosh, like that's too low of a standard. And like customer count is actually can be misleading if the weight of your business is distributed differently than the average.
Hey, thanks for listening. We'll be right back after a word from our sponsors.
Ali and the team at Tabs are building something that directly addresses one of the biggest headaches I see finance teams deal with today. Pulling data from your ERP, your CRM, your FP&A tools, and your usage systems and actually making it all work together. If you're running usage-based pricing or complex contracts, you already know how this usually plays out. Contracts live in one system, usage data lives somewhere else, billing happens in another tool. RevRec gets layered on top at month end, and finance ends up just reconciling everything by hand to close the books. This is exactly the problem Tabs was built to solve. Tabs is an AI-native revenue platform built for controllers and CFOs. It brings together data from your ERP, CRM, and real product usage into a single system of record. From there, it automates billing, collections, and revenue recognition without finance having to duct tape workflows together every month. If usage-based revenue is core to your business, this is the future of how billing and RevRec get done. Go check them out at tabs.com/run. That's tabs.com/run. We've all been burned. We've all bought that enterprise planning tool that promised the world, only to realize 6 months later that we've basically taken on a second full-time job just to keep the software running. I want to talk about a company that was built specifically to kill that cycle, Abacum. I actually remember my very first conversation with their founder and CEO, Julio Martinez, over 3 years ago. Back then, they were just starting out in Spain. Fast forward to today, Julio moved the home base to NYC, and they're the engine behind finance teams at Strava, Replit, and JG Wentworth. Abacum doesn't turn you into a software admin. The integrations are actually self-service. You don't need a $300 an hour consultant to plug in your ERP or HRIS, and they're doing AI in a way that actually impacts the things FP&A teams are doing every day. Things like creating variance summaries, building formulas, and modeling scenarios. If you're scaling fast and you're trying to avoid that legacy platform trap, Abacum is the move. They're building the future of our tech stack, and they're doing it with a CFO's perspective. Go to abacum.ai to see it for yourself. That is abacum.ai. If you're paying for A-level finance talent, they shouldn't be doing B-level tasks. CFO time is expensive. Senior finance hires are wicked expensive. And yet, in many companies, highly paid operators still spend hours reviewing expenses, chasing receipts, and reconciling systems that should already be automated. That's where Brex comes in. Brex is an intelligent finance platform that combines corporate cards with built-in expense management and AI agents that automate the repetitive work finance teams usually handle manually. Transactions are categorized automatically. Receipts are matched. Policies are enforced in real time. Reconciliation just runs in the background. So instead of adding admin as you grow, you increase output per finance hire. Brex is already automating hundreds of thousands of hours of manual finance work every month across 35,000 companies, including Anthropic, Coinbase, and DoorDash. If you want your finance team focused on performance instead of paperwork, check out brex.com/metrics. That is brex.com/metrics. Jason, you mentioned that you think about the company having many CFOs dispersed throughout. Have you embedded any cadences at Faire that help you plan and predict better?
We are big on planning. I would say like this is probably an area where I've tried to also iterate and evolve over time. The act of planning is actually probably arguably as valuable or more valuable than the actual plan itself. As we're like, building a bigger business, like don't get me wrong, forecast accuracy is super important. The plan is going to get things wrong, right? You're going to have new information. And so I say that because you want to have the right cadences because part of the value of the plan is to understand what new information gets surfaced, what's different from the understanding of the company or of kind of the team. And then you understand the ripple effects across the plan and across the different teams. And then you know how to adjust course. Then you can think about like, okay, well, what are the cadences? Like, what do we got to do to kind of navigate that? So like many other companies, you start off with your annual plan, right? And that looks at the annual view. And the intention there is to bring together the tops down strategy, tops down company level objectives with bottoms up perspectives from the teams. And then you make explicit trade offs around priorities, make explicit assumptions, right? Informed assumptions about the model, the growth, how investment plays out. And that sets the direction. Then it's like, okay, well, what are your cadences throughout the year? And so then we have our quarterly planning checkpoints, right? Each quarter, we're going to learn new things about the business, new things about the market, new things about our execution. And then it's about adjusting those assumptions, reallocating the investment, and just making sure that we're staying close to the reality and versus being dogmatic about our annual plan. So that's kind of the quarterly cadences. And then the last piece is then the right feedback loops for more real-time visibility. We have daily dashboards. We have daily dashboards for the top KPIs. We have the bi-weekly reviews for deeper color. And then I do a monthly financial review. At least for the monthly financial forum, it kind of comes back to that premise, right? It's like, it's so easy in those monthly financial reviews actually to be just backwards looking up like, what just happened? And explain what happened, and that's it. I actually just had mine today, actually, our monthly financial review. And we've kind of evolved the structure of that meeting is, yes, we want to understand what happened, but what did we learn? What does this mean going forward? That's how I thought about, call it the broadest of cadences, and then to the learning and iteration. And I think there's like different cadences, and it's being deliberate about what you do at those cadences. As you can imagine, like trying to do everything daily, having too much stuff daily is then you have issues around signal to noise.
This is amazing. This is the inside baseball that people come to the podcast for, Jason. So to play it back, you have something on the calendar for discussion, a compelling event on a weekly basis, a biweekly basis, a monthly basis, and a quarterly basis. And then you have the annual planning process too. At what point throughout that will you actually reallocate resources if need be? Can it happen at any point, or is it on the calendar like quarterly? This is when we actually will start to toggle stuff.
If done well, if done right, you make the majority of your investment decisions as part of the annual plan. But kind of the point, like your annual plan is fundamentally, it's going to get some stuff wrong. And you need the agility and flexibility throughout the year. Now, I think you can go to the other polar extreme and just say like, oh, we can reallocate in these like one-off decisions. Well, the problem with one-off decisions, if you did everything that way, is it's totally blind to other decisions that you're making, right? And you have no relative understanding, holistic understanding of like the relative importance and prioritization. On the other side of the spectrum could be a challenge. And so what we try to do is we try to have the majority sit in the annual plan and the majority sit in the quarterly. Force ourselves to look at what are the 10 decisions that we have to make versus only focusing on the one. And we try to be disciplined about funneling those decisions that can afford to wait. Now, not all decisions can afford to wait, right? And then so then you have to like build the flexibility in your plan and the judgment around what are those exceptions where just like it's so clear and obvious, just go do it. Or of like, hey, there's this marketing spend that is so efficient, such high ROI. You already have the ROI construct that like we should always go after that. And then that means that your plan needs to account and give you the flexibility to do it. One of the things I've learned is like there is a people dynamics, an org dynamics. And we'll say it is a lot harder to take money away from somebody than to give net new.
You said something so compelling around the dangers of making one-off changes. Because you can run around thinking you're doing a service to the business by, oh, I'll change that. And you run around with your hair on fire and you think you're being efficient. But really, you're making decisions in isolation that take you away from those first principles.
A big thing that I've tried to press on for the company is around like return on investment. And like you could focus so much on the individual decision, but I think like from a CEO's perspective and from a CFO's perspective is like it's not just the individual decision, it's also the portfolio view. Too many one-off decision means that you're very narrowly focused versus holistically focused, and it's not just around the ROI, like that is a big part of it, but there is the like, hey, what are your broader principles and guardrails for your return investment across the portfolio? How do you think about long term, short term? How do you think about like execution capacity? It's not just dollars. There is a organizational execution capacity. And so zooming out the quarterly and annual level and even the long term level forces you to like think more holistically about that and think about the portfolio versus just being stuck in the like one off this decision on its own without even consideration for all that other stuff.
It is a maturity thing you have to go through, though, to let some small fires burn so you can aggregate all the fires and say, this is what we actually need to do.
I think what you can also do up ahead of time is set your frameworks so that it doesn't feel like every decision you have to like relitigate. Once you've set your framework up front, you kind of know going into the meeting that was like, hey, we should probably do this. Our framework support it. And then so then you're like really then thinking more about the trade-offs. And I do think part of the finance job is to build the framework so that not just that it's like a thing that is operating at a castle tower, but you actually bring it closer to the like ground level to the teams because then they can self-serve and they can actually reason about it too.
I do want to dig into ROI as a framework. So if we were to give people an on-ramp to understand this, can you break down the different elements of ROI?
We could probably spend hours talking about ROI. I mean, ROI, LTV to CAC, like the whole gamut. You learn new things about it. I actually just wrote an email to my team saying how our investment framework, our ROI framework needs to evolve to like a V3 in this year because of some new learnings. Conceptually, there's like two things. There's two things that I think are kind of core premises that I have, which is ROI is like fundamentally, are we getting disproportionate value relative to the cost and the effort that we're putting in to something? Then it's around like, okay, well, if we can consistently invest at strong ROIs, right? Disproportionate value to the cost, and we can then scale those investments, right? Scale sales, marketing, scale R&D, to get that disproportionate impact. Then you'd end up building a pretty valuable, high impact, high growing business that can not only sustain itself but be truly profitable growth, right? So it's like those are the two premises. Let's go to the next layer down, right? So then it's like, okay, yeah, the element, what are the elements of ROI, of return on investments? And so the return, measuring the value you create for the business. I think there's probably an infinite amount of ways to define the R. Even before you talk about the R, make sure that you like actually can define and instrument basic things like revenue, contribution profit. You can then define the return, but because you actually have the understanding there, and then it's really around, okay, cool, then define it in a way that you can action on, right? For sales and marketing, the like classic definition there is, okay, the lifetime value of a customer, LTV. If we define it as a contribution profit for our customers over the life when we bring someone on. For R&D, what we try to do our best on is, okay, well, what's the change in customer behavior? And does that customer behavior, can you reason or connect the dots on downstream on of buying volume increase that leads to a revenue increase? And you can kind of reason about that. So that's like kind of the return. There's the investment part of this equation, right? Which is like, what is the cost, the effort required to generate that return? In some cases, it's pretty clear cut, right? There's a media spend for a marketing campaign. The watch out is to make sure you're being very deliberate and clear about the holistic view. There's like the direct cost of something, but for the marketing team, there's the paid media spend, but there's the entire team and the systems and the tooling to enable the broader portfolio of marketing spend. But that's kind of what the concepts, right? Return on, and then there's the investment piece, and then like looking at that formula, looking at the ratios that serve the business in the right way. And then there's just like, how do you apply it?
What's evolved the most for you, the R portion or the I portion?
On the R part, the return part, particularly as the business gets more scaled and more sophisticated and has a wider range of opportunities, no opportunity is the same, right? So like you want to have one number and one benchmark for all investments, and like that's just not how the reality works, right? There's short term, long term. There is investments that just show up in the P&L, but there's investments that require a cash investment, right? So that shows up in a different way. And so there's like different, I think, ranges of investments that both have an impact on how you think about the R and measuring it in the right way, as well as the I. It's both. I think you kind of have to evolve and look at both. I think one of my biggest learning comes from this. How much time are you spending making the best individual decision versus the best portfolio decision? So much of your early time is focused on driving clarity of ROI for the individual decision so that like every individual decision is good, meets the bar. I think the evolution is my job and the CEO's job and the executive team's job is, well, how are investments distributed across the different types of investment? And I actually think one of the hardest things to do and I think under recognized is do you actually have the visibility of your investments and how it's distributed in the way that you make your investments, right? So much of our financial systems are built around tracking investment at like the department level, all the ways that might not actually be aligned with how you think about the investment decision. And so we've spent a lot of time trying to instrument and reason around what are the views that are helpful for us to understand the mix of our investments by R&D and sales and marketing. Like that's the obvious thing, but like even within that, by channel, by motion, by different product strategy initiatives, and even things like core bets, core incremental high confidence, core business, emerging and like longer term experimental. I think that is like one of the most important things to do, but one of the hardest things to do is to actually have that portfolio view, aligning your investment framework, investment strategy with the actual business strategy. It's so easy to say, but it's actually really hard to do. And I would say like that's been one of the biggest evolutions, I would say, in my time at Fair. But then now we're thinking a lot more deliberately about the portfolio view and the mix and all the different ways that we want to understand it. And then ultimately to get the right feedback loop around how do we evolve it? How do we change it? What are we learning?
It sounds like you're making a portfolio of risk adjusted bets.
I wouldn't say it's purely on just accounting for risk. I think that is one element of it, right? And I think risk or kind of level of confidence is certainly a factor in how you think about ROI, right? Like the higher the risk or the lower the confidence, you should have more margin of error and have a higher ROI to compensate for that. But even if I think about the portfolio view, like even looking at it from the core, emerging, and then this experimental stuff, right? Like the experiment is definitely an element of risk. These are long-term bets that not all of them will work out, and so you need a portfolio of them, and that's the risk element of that. But you need to think about the long term because there's also around like what is the scale of the opportunity of those experiences if it goes right, and like how do you find those asymmetric opportunities? So it's like risk adjusted, but also with an understanding of the upside opportunity, the TAM. And I think you need to have bets in each one of those categories because, if you really think about long-term growth and long-term growth beyond the next 3 years, the next 5 years, the next 10 years, and like every scaled business has had to make bets of like long-term bets that have higher risk, but there's the asymmetric upside and from a size perspective.
You've said that discipline isn't about saying no, it's about knowing where yes matters most. I want to get into this because often on the podcast, we talk about the art of saying no gracefully. I think there's also an art of saying yes to the right things. So can you expand upon that?
Both are important. Like if there was feedback to my team is like, yes, we need to learn how to be firmer about things, but like what do I actually mean about that statement about, discipline isn't about saying no necessarily. It's about saying yes. I kind of come back to clarity. What are the things to say yes to? Right? And what are the things that you say yes to over others? Because a big element of the job is trade-offs, right? There's finite dollars at a given point in time, and there's finite execution capacity. And so it's a question around what do you say yes to so that your dollars and your mind share and your time is flowing to the highest impact areas. Kind of in the same way where like infinite amount of data can actually create a lot of noise, infinite amount of priorities and infinite amount of things to do actually can create execution challenges. I actually think constraints are quite powerful. That like forces people to be much more clear and represent their conviction in something. And if you like don't have a constraint, it's actually pretty murky sometimes. And then in some cases also, how do we want to sequence, right? It's like, yes, but yes at that point in time. But the last thing I kind of say about this also is it's saying yes to the importance of value of efforts that drive to remove inefficiency. So much of like the effort, it kind of like so much the natural inclination is to focus on the R and drive more growth, drive more growth. But there is also a lot of ROI around attacking inefficiency, right? And you can easily create an ROI equation around what is the effort to drive to remove that inefficiency. And oh my God, there's like a 5x return in a very short amount of time. And what does that do? It actually either gives you more profits or allows you to reallocate to the highest leverage areas. Very recent topical area is probably relevant for a lot of folks is like infra cloud AI spend. In a world where it's just usage, it can balloon in your face super quickly. There's all the usual stuff that you can do there, but, we had a kind of a lot of dialogue with our technical teams around, well, this needs to be part of an input. And like, are there things, actions that we're taking where it's disproportionate cost of return, but it's kind of buried? And so then there's disproportionate value for spending a little bit of time around finding that low hanging fruit. And so we gave them a mandate, and I just, like, came out of a monthly financial review, and we're like, "Oh, yeah, here are 10 things that we had 10 engineers spend a couple hours of their time, and just boom, hundreds of $1,000s of savings that we've gone to redeploy."
That's an awesome and clear framework. I want to transition with the time we have to some questions just around running your cap table and fundraising. And one thing that I observed was that Fair actually went and proactively reset its valuation. And you don't see many companies at all optimizing for clarity rather than the comfort in these situations. Can you take me through that thinking?
Like many other companies from ZERP from 2021, like, the Fair's valuation peaked in 2022 at $12 billion. And then, like, okay, well, what was the backdrop of that time? And I think a lot of people are familiar with it, which is like two things. Is one, market valuations, came down meaningfully, right? Because like people understood, like, okay, what was the true run rate, the trend lines of, a bunch of these. Second point was the industry and our business and our understanding of the run rates and the growth rates of the business. That normalized too. And then I would actually say the third thing is like that was also a time we were overly aggressive on our investing, hire too quickly, hire too like there's too many layers. So you had all of these things kind of coupled together during that time. We did a restructuring. There's certainly a cost side of that, and there's also kind of an execution on that. Too many layers does slow the org down. And so we reorg, cut out layers, and just be very deliberate about what is the right org design given the business, given the objectives, given, and constraints to some degree. So there was we did the kind of a reorg. And then on top of that, at the same time, I wouldn't advise this to anybody, but it was the right decision for us. It was we also restruck our valuation. We reset our valuation internally for issuing equity. We reset it from 12 to 5. Could have been very easy to kick the can down the road. And I think one of my learnings, and it was like very clear from, it was hard, but it was very clear both between feedback and the historical patterns, which is if you're going to do this, do it right, cut deeper, reset your valuation lower, because then you can find your floor faster, right? Maybe it's painful, and then you can build from there, right? And then there's so much power to progress and momentum from there versus this like drip effect of like you don't know where the bottom is. So then like everyone extrapolates to infinity and then all of a sudden they extrapolate to the floor. And it was pretty painful, but it was so much better because what you get is two things. You get clarity on the floor, build, and there's like less ambiguity of like what you're trying to solve for in the future, right? Maximize long-term growth with good ROI. That's like, okay, go. We don't like, we've already cut a lot of stuff out. You can just go now. We can figure out which heads to add on, back on. And then I do think it builds you trust, right? That like, hey, you made the hard calls. You didn't kick down the can down the road. You made the decision when you needed to make. And so I do think there was a level of trust.
I applaud you for doing it the right way and taking an aggressive approach and being proactive, because there's nothing worse to employees and even to the outside world if, like you said, you can't find the floor. You need to reset it to a position where you can credibly build back. There's nothing worse than a company that's going to do it, you know, half-ass 4 different times and people are like, well, what's going on here? You got to build back.
A superpower at Fair has been we don't shy away from hard choices. We don't shy away from complexity. We embrace complexity. Sometimes like it's an overstrength, but if it's in the interest of the customer, if it's in the interest of the business, we will embrace it. And I think, that's really what's allowed us to like attack these things head on.
And speaking of getting to the other side, congrats on running a successful tender offer. Maybe you can elaborate on what went down there.
In its simplest description, like what is a tender offer? It's a structured way to provide liquidity to your employees. But the reality is it's so much more than that.
I've helped run them before, and I'm like, oh, wow, we signed up to do a lot here.
We signed up to a lot. And like it's also the work ahead of it to set you up, right? Because yes, it's liquidity for your employees, but there's actually a bunch of other things that you're trying to do, right? You have shareholders who buy into the company. So by in that respects, the insignificance of a tender is to set an external mark on the valuation. I think the two is like there is a signal of the tender or the secondary itself. We wanted to be very deliberate about who were we bringing on, right? Are they the right partners? Are they long-term investors? And honestly, a little bit around there's the social proof to other investors of someone has underwritten our business, and the quality of the investor does matter. We brought on WCM. They're a public crossover based in Laguna Beach, probably not your typical location, but they have $100 billion of assets under management, and they invest public privates, and they have a great set of portfolio companies in there. We had an insider, Bailey Gifford, they're a public fund, and I think why that matters, and it was a little bit surprising to me, I think, and looking back now was, I think when we announced it and I was at an investor conference, like we were right after we announced it, it was almost as important was not just, hey, you did a tender and oh, what's the valuation, but who was it with, right? It wasn't an insider driven round that they could just because they wanted to get more equity, they could just assign a big value. It was quality investors who are investing at the rigor that we need at the next side, doing deep diligence.
What you said too about signaling and back to the credibility piece, that you have amazing investors coming in who invest at the next stage of companies too, that you were able to check the boxes and pass with flying colors that yes, this business is great. And they can also report in a way that's repeatable and clear.
We learned throughout the way around how do we represent our business? How do we represent our business in a rigorous way, but in a way that's like a new investor could pick up. The work for a tender doesn't start at the tender. It actually starts years before, ideally, or at least a year ahead of that. Because what you have to do is you need to educate the investor. My first meeting with them was actually almost a year before. And we actually had multiple meetings ahead of actually launching our tender so that they had the conviction coming in and they like already knew us and they just added conviction. They had the pattern recognition on the quality of how we represented our business and the kind of the through line on like we do what we say and we like do more. And then I think the fun part of the tender too was like these are high stakes moments. So it kind of puts a little bit of test around when they ask these diligence questions and they ask these in a deeper way. Are you thinking about your business in a way that's like that's deep and rigorous to then represent that? I would say I give a lot of credit to my strategic finance team because they actually had set a lot of the foundation even before I was here. We kind of earned the credibility because the quality of the work, the rigor, the understanding, the explanation, the translation of like, this is how it should play out and it playing out that way of the inputs, the outputs, right? I think that was helpful signal for them. And it kind of gave them a little bit of preview in terms of the culture of both the finance team, but also the company at large. And they spent a lot of time with our management team as well. And so that those are all, I think, important inputs for them.
And it goes back to the idea of building lines, not thoughts with investors. I really appreciate how you said that started years prior with being able to say, listen, this is what we're aiming for. And not only doing that, but exceeding it.
You have a conversation with an investor in an IPO roadshow, and they're like, "Oh, tell me about yourself." You have failed. Like that conversation is so unlikely to actually translate because like an investor is making a bet and they like need to do diligence. And so if you really want you put yourself in a position to have investors have conviction, they have to have the pattern recognition of you as a business and then the leadership team too. And that is highly applicable and it's kind of played out that way in the secondary for us.
Jason, I'm going to take you into what we call our long ass lightning round. So the first question that I ask every successful finance leader is, what's an example of something you've screwed up on the job before?
I led the IPO process, right? And I was kind of sharing a little bit about that. And it was unclear whether I should run the investor relations team. I had no business running the investor relations effort. Why? Like I knew everything about the business, but I am a introvert. My parents were like, "You're a spokesperson. Like, how could you, Mr. Introvert, be a spokesperson?" And I remember my first meeting. It was in New York. It was actually the second day post going public. I worked on all the internal things, forecasting, and I knew it cold, but I remember that meeting very vividly because I remember I was sweating under my palms. I was nervous, like questions that would be a cakewalk around like, "Oh, why does risk loss matter in your business? How does it work?" And I just all of a sudden I was fumbling. And it was almost one of those things where it's like the first fumble just creates the snowball on everything else. Your job is not just to know the substance, it is to bridge the last mile. And that is really important. And so I spent a lot of time screwing up more times, but also like you just learn, you build the reps at it. And you kind of have to embrace that a little bit. And I'm not sure if you kind of call it a screw up, but I just remember it was a pretty vivid experience for me.
We've all had those. If you could tell your younger self something knowing what you know today, what would you tell them?
I'm gonna steal a line from one of our board members, but I'm gonna morph it a little bit. Earn success. And I love it. It's supposed to be hard, but when you actually earn it, it feels like true, like you've like really earned that success. Particularly for finance careers, and I think myself was included, is like you kind of have this like linear view of success. You go to high school, you go to college, and then I remember like there was this finance blog called Mergers and Inquisitions, which was, it was like you start as an analyst in investment banking, then you go into associate as a in a private equity fund or a hedge fund or some other growth fund, then you go to business school, then you go to VP, and then there's this kind of linear progression to this concept of greatness. And the reality is, like, life doesn't work that way, and, like, I think it's so easy just to want to believe that, but, like, it really doesn't look that way, and then, like, when I look back at my time at Square, it looks up and to the right? Just this linear progression up and to the right, but then when you zoom in, there's peaks and valleys, and I think those peaks and valleys are actually kinda like the formative. You wanna earn your success, it's not supposed to be linear, so embrace the peaks and valleys. I guess here's another quote for you, and it's like actually comes from the former head of comms at Square. He said that if you're not scared, you're not learning. You learn the most when you're stretched and you're like a little terrified, a little scared. Earn your success. Don't expect it to be linear. Don't run away from being scared.
Sage advice. More of a technical one. Can you take me through your finance software stack? What tools does your team use to get the job done?
We have our NetSuite as a system of record, and NetSuite it's NetSuite. It's like, and we have Workday, we got Workiva, we got Pigment for planning. So I wouldn't say it's like that interesting, but where I do like the natural energy right now and where our push is around like how do we apply AI? We were a big goose egg zero there. Like people maybe using ChatGPT in their personal account, which is terrible. What struck me is like I went to like a CFO event. It was hosted actually by Sarah Fryer for CFOs. And I saw that and I was like, holy shit, we are so behind. This is the future. This is like bigger than Excel what is for the analyst. And so since then, we've done stuff like, hey, how do we experiment? How do we create hackathons? How do we set OKRs? How do we have pilots? A fun example to share. And, arguably where we're a little bit, I actually do think we're like ahead here, which was On the strategic finance side, like it's actually the place that like a lot of CFOs, from what I understand, like they actually haven't put that much on the focus there. Like all the AIs around automating the repeatable stuff.
The accounting stuff.
And we're doing that too. But one of the things, the magical thing that's happened, we connected Claude to kind of our data warehouse, for all like our business data and a lot of our financial data to kind of Snowflake, through an MCP. That in itself doesn't solve anything. It then becomes like, what do you actually do with it? If I was to summarize what's happened, if you have the right person, you can bring down and dramatically lower the cost of analysis from like a day to 5 minutes. When you can bring down the cost of that analysis, you can actually ask deep and broad sets of questions, and you can iterate on them so much faster. For us, was highly relevant last year. Tariffs blew up in everybody's face. And so if, the natural question for us was, well, how does this shift our business? How are customers reacting to it? How do we know if it's truly tariffs or some other dynamic? And I think historically, it would have been really costly. The pressure is actually not on the, like, can you actually have the technical abilities to query the question? It's how good can you structure the question?
Last one I got for you, more of a fun one. What's the craziest thing you've ever had someone try to expense?
I think I've gotten pretty lucky so far, but here's like 2 good stories for you. The optics of it were so bad, and the logic behind it was so bad. This was like earlier days in Square, but I had discovered that we were spending over $500,000 on these freshly squeezed coconut juice. It later became coconut juice plus like other vegetable juices.
How much?
Over $500,000. Part of it was like, hey, the office person wanted to be really responsive to like some off comment that some executive said. And it was more than all of the other drinks combined. The double kicker is that these juices expired every single day. So then you had some employees who thought they were doing a service to the company by saying, oh, these expire every day, so let me bring these home so they don't go to waste. And then the office person looks at the fridge and be like, oh, highly in demand, let's stock up more. Yeah, it's like harmless, but actually it quickly becomes not harmless and then, becomes very unreasonable. So probably another one would be like, I think we had one town hall at Square where like we moved into a new office and we went from catering to like in kitchen, right? But like no one thought about the difference between CapEx and OpEx. And so all of a sudden this first town hall was like, why is there oysters? Why is there king crab in here? And like, the response was like, hey, this is within budget. We can do this. And it was like, oh God,
Optics.
something is massively broken. And the optics were awful.
Both of those stories are hitters. Jason, this has been an absolute blast. Thank you so much for joining me today.
It was fun chatting through these, and let's definitely do this again.
Run the Numbers is a mostly media production. Yelling and intro by Fat Joe. Artwork by Meg D'Alessandro. Show is executive produced by Ben Hillman. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog way too much ice cream and has a history of net operating losses. LOL. If you like this podcast, hit subscribe and give us 5 stars. It will take like 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a great day. Peace.